Righty. Happy Sunday, everyone. Happy Mother's Day to all the mothers out there. Thank you all so much for tuning in. I know this is kind of a weird day to have a stream, but we always got to talk about what's going on into next week with the markets. So first and foremost, happy Mother's Day. Going into the agenda for today, segment 1 and segment 2 are going to be done by Steve Strazza, our guest, and I'm pretty sure I said that right. It may be Strazza. You're going to have to correct me here in a second, Steve. But the first and second segment, we're going to be looking at how Steve finds an edge in the markets. And while he's using that edge, we're going to go into segment 2 and look at his watch list going forward into the weeks ahead. And then, as always, segment 3 and segment 4 are going to be the broad market recap and the top requested charts. And we're actually going to do a little bit extra today. We're going to do a live chart request. I'm going to mention that here soon, but I already did, so might as well start already. Everybody start mentioning some charts. Please don't flood the channel, but if there's a chart you want to see and we see enough of that ticker, we're going to do the top 3 most requested charts on the chat today, and Steve is going to do that for us live. So that's going to be pretty fun. And without further ado, I'm going to invite Steve on to introduce himself, tell everybody a little bit about All-Star Charts, and let's jump into segment 1. Welcome, Steve.
How's it going?
Oh, going great.
All right, let me share my screen here. All right, so are we all set? You see me? Cool. So I wanted to focus on, finding an edge. One of the ways that we do that is really by identifying key levels of interest, right? So what I want to focus on today is that support and resistance, first of all, it could come in many forms, and we'll get to that. But one of my favorite sayings, and I don't know who said it, and I'm probably going to butcher it, but it's just a common market aphorism. It's that support and resistance levels should be drawn with crayons, not pencils. And all that really means is that these are levels of interest. They're zones, right? They're areas. We draw them with rectangles most of the time. They're not a fine line in the sand. And the sensitivity tool on TrendSpider is what we're going to focus on today to kind of show how that can benefit us and give us an early alert when something is approaching our level of interest, because it's really the exception to the rule. It's the exception, not the rule, that these levels are ever tested with perfect precision to the penny, or even, to the dollar, depending on the nominal value of the stock that we're looking at. So real quick, let's just give a quick background. One of the things that drew me to technical analysis earlier in my career is I was an economics nerd, and hearing people in the field of TA. Brian Shannon's a great example. I know he's a buddy of your guys, and we'll talk about the anchored AVWAP in a little bit. But hearing people like him just talk about supply and demand and how that drives the market and the prices that we're looking at, that is something that really spoke to me early on. And that's exactly what creates levels of support and resistance. These levels of interest, it's supply and demand. It's buyers and sellers are attracted to those levels. So without getting too deep, what it really represents is a very brief, unique level of equilibrium between buyers and sellers, between supply and demand. And that's why price will chop and go sideways and typically digest or consolidate at these levels. They can also be completely ignored, like we saw to the downside in March and February of this year. So why is this cool? Why does this make sense through the lens of technical analysis? Well, it's because supply and demand is created by human emotions and really investor psychology. There's price memory. So if you look at the chart I have up now, this is the S&P, the most commonly or most popular chart, or probably the most analyzed chart of any, asset in the world. And you can use so many different tools to identify levels of interest on this chart. And we're going to look at how investors and prices therefore react to them. So we could just jump right into the examples from here using the sensitivity overlay. How does that work, Jake?
Sorry?
Should I just dive right into some examples now? I mean,
yeah, whatever you want. So, for SPY, I guess the first question is, for the 2 moving averages you're using, Why are you using those? Is this something that you would overlay on any chart you're looking at, or are these two just for SPY? Maybe a little bit about that.
So moving averages are not magical levels of support and resistance. They don't have price memory like prior highs, horizontal support and resistance, or your anchored VWAP would. But they don't need price memory so much because it's simply a mechanism of what are market participants paying attention to. So the reason why I use the 200-day is because that's the most popular moving average. So if other market participants are paying attention to this little line, then I want to pay attention to it too. And you can see right here on this chart, it's very much respected. And again, not to the penny. I've drawn sensitivity bands around here to alert me when price gets close to either one. The exponential is in red because it's faster. And you see that here. So if you're paying attention to the exponential, it'll create more whipsaws and false signals, but it will also get you in and out of trends sooner. So the smooth or the simple moving average is just a bit slower. But I guess my point here is if you throw them both on the chart, it's quite obvious that investors are paying attention to these levels. Therefore, I want to be too. Does that make sense? So I'll move on from here. This is using a moving average as an example of support and resistance, right? But we can also do this a number of different ways. Let's look at using the anchored VWAP as a level of support and resistance. It worked really well, the VWAP, with IPOs. And the reason for that is we don't have peaks and troughs and a lot of price memory in these stocks. So the anchored VWAP is really just giving you the best representation of the shared memory of market participants, right? It's the average price paid for the security from whichever date you anchor it from. So here's Beyond Meat. I've anchored a VWAP from the high here and also the IPO date. As you can see, price slowly climbed. It respected the VWAP from its IPO. Prices came down. They tested this potential support at the VWAP. They reacted, and then finally that level broke right here. Okay, prices were trapped down here for a while. Not really something we wanted to be in. You could draw a little resistance line right here. We broke through, ran up to the VWAP. Now both of them are converging here, so it's an even more powerful signal. Jake made a great point on, I think last weekend's webinar, where he was saying we look for stuff like that. When we see different signals all giving us or all converging, that's like a confluence of support or resistance. So we want to pay extra attention to those areas. So I got two VWAPs here that price is trying to run into. That's a lot of potential overhead supply for buyers to work through, and they failed, right? And we went back down, we violated the lows, we retested the IPO low. That's a key level of interest. That's price memory right there. Then we shot back up. We ran right into the VWAP. Let me get these out of the way here. The exponential moving average and the simple moving average are only showing up at the end of the chart because this is a pretty recent IPO, so there's not enough days of price history to see a full 200-day. But anyway, you can see price just ripped through the both of these key anchored VWAPs and all as well as some prior peaks, some significant price memory from earlier in the year, from January and February. So this is one I would definitely keep an eye on here. You have these significant lows here that are lining up with these peaks here. Let me show it to you guys. You have a gap somewhere in that area as well. So if we throw that up, again, we draw support and resistance with crayons. That's why I'm going to put an alert around it. And there you have it. I want to know every time we come close to this, right? So for a lot of reasons, there's a lot of important price memory and potential overhead supply that looks like it's being absorbed and worked through here. You could probably also draw a trend line on this. So that is a perfect example of the confluence of signals. In this case, it's a confluence of bullish signals because price is penetrating this former resistance that will likely turn into support. So that's how we used a VWAP to identify levels of interest and potential levels of support and resistance. Another good way, probably our favorite way, to identify potential levels of support and resistance is through ancient mathematics that you will often hear referred to as Fibonacci retracements and extensions. So here's a chart of XLK. What I want to show you here is, okay, so 1 week. There you go. So this is a Fibonacci extension. It is anchored from the August 2018 highs to the lows from January 2019. So what you see here is price runs right up. It kind of chops around the 161.8% extension. And then in January or early February, we actually turned bearish, and we wrote a post about selling tech stocks. And a lot of people, why would you sell tech stocks? They're at all-time highs. They're showing absolutely no signs of, a trend reversal. But actually, we saw this hidden resistance here at the 261.8. Did it hit it perfectly? No, it didn't hit it to the penny. That's why I have sensitivity alert on it. If you look at the daily, it actually looks a little bit different, right? So if you draw this same Fibonacci on the daily chart, I apologize, I have two drawn here, so I'm just going to redraw it. So here you can see it really doesn't line up perfectly at all. So if I were to anchor it from the absolute low of the daily and get closer to the high here, as you can see, we didn't exactly kiss it. We came close enough. That counts. Okay. So that hitting this logical level of overhead supply or resistance, as well as a nice little momentum divergence here on the RSI, that was enough to get us to kind of want to take profits in this. Did we know that it was about to plunge 30+%? No, not at all. But we did know that we were getting greedy up towards this level and probably wanted to take some off the table. Now, maybe the simplest way, because now that we've covered moving averages, Fibonacci's, and the VWAP, another thing to look at is just the trend line. So I want to zoom all the way out. Who doesn't love talking about tech? This is the strongest trend of any sector in the market for over a decade now. This is just a simple trend line, an uptrend line drawn from the March 2009 lows. As you can see, we had some volatility in August 2015, a bit of a flash crash there. Prices flushed mid-month. This is a monthly chart, but this actually happened during the day. So you would have, if you were basing it on closing prices, you wouldn't have been out here. And again, this sensitivity analysis picks up a lot of important areas where price kind of pulled back, but then buyers stepped back in. That makes a lot of sense when you're in a secular uptrend like this that just continues to stair step higher. So by just drawing a simple trend line and putting a sensitivity alert on it, this would have kept you in this trend this entire time, and you'd still be in it.
Love it. So as far as kind of like using all of these different variables in your guys' work, let's go into segment 2, going into kind of the list that you guys have moving forward. And so I will go ahead and share my screen again. We'll jump into some of these symbols that you've talked about. Let's go through each one of them, and then after we do, we'll essentially be able to kind of see these visually. And just want to make
Sure.
Alrighty. Oh, we're good now. Alrighty. So segment 2. We talked about in segment 1 what you guys used. There's a lot of tickers on here that I've never even seen before. So walk me through this list and kind of, what are these all based on one setup? I know we'll go into the visual here in a second, but ILF, FM, IBB, are these all kind of the same type of setup you were just talking about?
Yes, but in opposite directions, depending on the ticker. Yeah.
All right.
I'm more of a horizontal support and resistance guy, and you'll see that come through in these charts when we go through them.
Well, let's jump right in. You can go ahead and share your screen. So, as far as before you do that, like GDX, I see that you've got some subsets here as well as iPay. Is there a reason for that?
Yep. So that should be a nice treat for you guys because iPay is an area we started looking into towards the end of last week. It's been very strong. I'll pull it up right now. So we did a deep dive and we pulled some stats on the strongest holdings in iPay. And these are the names that came up. Honestly, I have not looked through all of them too extensively yet and done too much chart work on them. I just kind of took a quick glance. So we'll just do it live and look through a number of them. But you'll notice that a lot of their setups are going to be prices breaking out of big bases. Oh, I apologize. That was the wrong ticker, Jake. It should be iBuy.
Oops. Hey, well, they sound about the same.
Yeah, I get them both confused. iPay is simply, it's the credit card company, it's mobile payments ETF. iBuy is online retailers. And a lot of those names, as you guys, most of you probably know, are doing really well. That would include the Wayfairs, the Shopifys, the Amazons of the world. A lot of these stocks are dominating right now. So again, here we have a nice level of horizontal resistance. We breached, we plunged below, we reclaimed it, and now things are off to the races. You can do something like this here, kind of see how much legs this thing has to the upside. We just took out prior highs. The way we would look at this is we'll likely get a move back up at least to the 161.8% extension. That means a lot of the components in this ETF are probably worth looking at right now. So do you want to start with those, Jake?
Let's do it.
All right. Let's take it from the top. Mercado Libre, Meli. I believe they're an e-commerce giant in Latin America.
Sounds like the next Nacho Libre sequel.
So here we go. Let's just keep it simple, stupid. Boom. That's the level. I would call this a bit of a failed breakout. And we plunged lower. A little bit of a failed breakdown here. Ripped higher. And we had the breakaway gap. You love to see prices. This was a little bit of a bull flag right here. Right here. So after prices rallied, we had a nice little consolidation here. Then we ripped higher. And then you just saw this. This is what I would call like a power earnings gap. These are usually event driven, and prices shot right up, took out prior all-time highs. The next 2 days, beautiful follow through. If you see a setup like this, a lot of times, due to the power, the strength and momentum of this move, you won't even see a pullback. That's one of the most frustrating things for technicians, but it's a lesson that most of us will learn pretty early on. The strongest uptrends and the best breakouts often never retest, and a lot of times the breakouts that do retest, you don't want to be buying them anyway. So if this comes back and kind of holds up here around the $700 level, this is something we'd throw a tight stop on right below 700, and then bet on further upside. But I think even if it pulls back towards these prior all-time highs or the low of this breakaway gap, you could probably buy it around 725, 726 there. The next name is Flowers. This is 1-800-flowers.com. They probably did a ton of business today. Happy Mother's Day, everybody. Again, like I said, I'm probably going to bore the hell out of you guys by the time this is all said and done. I'm just going to be drawing straight lines all over these charts. This is another really nice base. Again, I want a nice big, what we'll typically do. That's why a lot of you might be looking at this and say, why is he drawing a sensitivity so large? Because these are zones. Like, I have no problem going like this on a chart. I'll draw a big fat rectangle on it. I want to know every time it comes near there. And then that's when I really want to dive in. I'll start looking at shorter time frames, longer time frames. You know, what's the underlying trend? Do we have some candlestick patterns in play? Whatever it is. But again, a very nice long term. This is a 1 year base, and it just eclipsed its prior highs. This is the kind of setup we love. Next, eBay.
eBay. Haven't heard that name in a hot minute, but it is.
I thought the same thing when I saw it on my list. I said, "Is that right?" This one's a blast from the past for sure. So, again, this is horizontal price resistance, prior highs. This is the polarity principle that you hear so much about. Once a level that is tested 1, 2, 3, maybe 4 times is finally broken, that's when you'll often see really nice moves occur. And the reason for that has a lot to do with the supply and demand at these levels. Stocks are not normal goods. They are price inelastic. Your typical good, when the price of it goes higher, people tend to buy less of it. That's normal. That's called price elasticity of demand. Without getting too much into the weeds, the stock market is often incredibly price inelastic. So what that means is that when prices go higher, people often want more, right? Just like economics are driven, or price elasticity of demand for most goods is driven by standard economics. For example, vice goods, cigarettes, tobacco, alcohol. A lot of times when the price of them goes up, demand doesn't really go down nearly as much as price goes up. A lot of times demand will stay where it's at, and that's because of addiction. And in markets, the reason why we have that inelasticity of demand is due to fear and greed and human emotion. So again, it all comes back to market psychology. So that's just something I've always found interesting.
Nobody's ever mentioned price elasticity on the markets on this show. I respect that, because I didn't really think of the markets like that. So thank you for mentioning that.
I don't think enough has been written about it. Again, I would even argue that so most assets have a negative price elasticity, most goods. And what that simply means is, like, even for the price of cigarettes, as that price goes up, people demand less. They just don't demand as much less in percentage terms as price increased, right? So you'll get a ratio below 1. But I would argue that in markets, you actually sometimes, and the elasticity is different at different levels, right? If you get a breakout above a 20-year base and highs that were tested 5 or 6 times, the inelasticity there is going to be extreme. And I would argue sometimes even positive. So positive elasticity literally means that as price goes up, demand is actually increasing. And that's something you almost never see.
Bitcoin.
So here's Etsy. This is another one. It's going to look really similar to the rest. Here you go. This is what we do. Keep it real simple. Boom, touch, test. Prices came back down. They chopped around for a long time. And then we took this level out. So it's on our radar. Again, a lot of these charts look like they've just been moonshots higher, but that's a lot about, that's what technical analysis is about. We're not trying to buy things down here. We're not trying to buy falling knives. We'd rather let them prove themselves to us, and then we'd be happy to buy high and sell higher. And again, with these two, you're not subjecting yourself to a large amount of risk. If you can catch these breakouts as they occur and get in, on day 1, day 2, your risk is very limited. If this is your stop, then yeah, sure, this stock has moved a lot in a small amount of time, but I'm not worried to own it at all here, because I know I'm only risking a few points of downside, especially if I buy the breakout, here. And then the way we would determine a price target for something like this, just to show you guys, right, because this stock is just breaking to new all-time highs, right? There's no price memory up here. This is no man's land. So how do we determine what might be a logical level for buyers to step in? I'll show you how we would do that, or for sellers to step in. I'm sorry. We would just draw a fib from the recent highs to the March lows here. This is your 161.8. So this is telling us that we got about 20 more points of upside. And if you're going to limit your risk to these highs at about 72, that's 8 points of downside. Not the best risk reward. So might pass on one like that, or buy it closer to this level of interest to get the risk reward where we want it. Does that make sense?
No, absolutely. No, R&R is huge.
That's
Huge
it.
in the markets. And I think, one thing that I wanted to mention is we just introduced a profit loss tool on Saturday. So that is something that just popped up, and I will touch on that before the show's over. But if you are looking to be able to define your risk and reward, we do now have that on the platform.
Yeah, very important.
Sorry about that.
That's the name of the game. That's awesome. I'm excited to see that. So again, you guys are familiar with this one. You're all watching it every night probably, except for tonight because we'll be watching Jordan. But Netflix, prior all-time highs, summer of 2018. Boy, is this a nice base. This is a weekly chart. I'd usually draw a big smiley face around this. We like to buy happy faces, bases, not tops. So, and then here you have it. If we zoom in here, right? So we just took out these prior all-time highs. There was certainly some price memory there. Price struggled there, and now you're seeing it consolidate right there. That's exactly what we'd expect to see. That's very healthy. And let's take it down to a shorter time frame, and you can see again, we kind of came back, corrected, overshot that former resistance, turned potential support. We overshot it to the downside, then ripped higher. And this is what I'm talking about when I say you got to draw these things with crayons. You got to kind of allow for something like this. Maybe the sensitivity here, wasn't big enough because the price closed below it here, and I guess you would have been out. But again, I'm not using any sort of math to make the sensitivity lines. I'm just kind of spacing them out a little bit to cover what I'm seeing on the chart. But the market is designed to do this. It's designed to make you think that a stock just broke out to all-time highs and it was a failed breakdown or failed breakout. This looked like a failed breakout for about 2 days here. You have algorithms, you got composite operators, simple way order flow works these days. The market's going to try and shake you out. You got to know that ahead of time beforehand and be ready for it and be ready to jump right back in, or just be ready to take a little bit more pain than you would expect, because those levels of interest are going to get whipsawed around before they're resolved. And this one looks like it's continuing to press higher. So until it proves otherwise and we drop below, I would say the closing low here around 404, then this is something that we could continue to bet on for further upside. One more in the space, Wayfair. Ooh, might have to zoom out on this one.
Their advertising tactic just worked, because the moment you said that, I had their slogan pop up in my head. So
yeah, I mean, this chart gives you just what I need, but but this one's really gone parabolic, guys. I mean, we've gone from what, $26 here to 188. So this isn't one I'd be really diving head over heels for. But again, you can see very simply the prior highs being eclipsed with a really wide range bullish bar. but I would expect this one to kind of cool off and take a breather. So it's definitely not my favorite on the list. That's it for I buy. I apologize for the typo on the slide. It should be I buy, guys, not I pay. Those are the holdings. All the charts I just showed are from the I buy online retail ETF. Amazon is obviously another big name in there, but their charts all over Twitter already, so you don't need me to show it to you.
Oh my gosh, seriously. Well, before we jump into segment 3, touching more on the markets, is there? I know you had a couple others that you wanted to mention this segment before we move forward.
Yeah, you want to look at a short?
Yeah, sure.
Again,
All right.
Yeah. I'm going to sound like a broken record by the time this is all over, but guys, you see what I'm looking at here? Probably. This is the Great Recession lows. So Latin America, this is the Latin American 40 ETF, one of the better barometers in the international ETF land when it comes to assessing, the strength of the market in Latin America as a region. So if I put an alert around this, a nice big fat one, because again, this is a decade plus base. You know how I talked about liking to buy smiley faces? Well, I could draw a big arc over here that would look a lot more like a frown. Okay. Prices tested this level, these lows from the great financial crisis in Q1 of 2016, when we had the Chinese yuan devaluation and oil crash mess. We spiked below. Again, like I said, the market is designed to do this and shake you out right before it rips. So if you got caught here, that stinks. Use the sensitivity alert next time. Now this time looks a little bit different. If we'll look at it closer up and I'll show you something else, but once this level of support here went, we plunged. And we plunged straight to, I don't know, the lowest level since about 2005. Okay, so we made fresh 15-year lows. And now what are we getting? What looks to me like a dead cat bounce. It's got nothing to it. Can't even get back above these closing monthly lows. Can't even get back to its financial crisis lows. This is something that if it stays below this zone, I would be fading strength in all day. So again, it's the same concept, just flipped around. A lot of times I'll invert these charts when I write our mystery chart post, because that'll expose people's biases. Some people have a long bias, some people have a short bias. When I first started charting, I could not short stocks. It just didn't work for me. So I started inverting all the charts that I was looking at and considering as shorts and asking myself, instead of would I sell this here, would I buy this here? Because I'm more used to betting on breakouts than breakdowns. But yeah, it's something you get used to, and it's really just the same thing flipped around. And also something to note here, this is a long-term base, right? So just how they say, the bigger the base, the higher in space. Well, the larger the top, the bigger the drop. So I would expect this to have legs. If I were to do a Fibonacci extension on this, it would go below zero for what that's worth. So you'd probably have to try and look at more of a measured move to determine a price target for this, or look back to some price history and kind of set your target somewhere around here, like this prior high from 2002. Either way, this structurally is a mess. And another short setup I'll show you guys. Well, actually, do you mind if I just show you this on a zoomed in time frame? I mean, yeah. This is when you know sellers are in control, right? There's a series of, no matter how you look at it, we got a series of higher high, lower high, lower high, low, lower low, lower low. This is a structural downtrend, really. Or if you want to call it a consolidation, that's fine, but it has a bearish bias to it for sure. And that just played out in real time. You saw the initial gap here, okay? Then we had a bit of a runaway gap here, and this is just very ugly no matter what time frame you look at. Now it's consolidating in a bit of a bear pennant. That thing's coiling up nice and tightly. If you see some downside resolution, that's when I would jump on the short side in a heartbeat. And then this, I never thought I would see this in my lifetime. I grew up in Connecticut. Yeah, GE's was headquartered very close to where I grew up. I know a lot of people who worked there. we were always very proud of GE, even, going to Fairfield University. I did my graduate work there. A lot of people were placed at jobs in GE, and you just never thought you would see this stock below $6 3 times in a lifetime. But again, this is just, another example of 2020. The best lesson from 2020 is always expect the unexpected. Expect oil to go to zero, even if people say it can't. Expect interest rates to go negative. Expect markets to fall faster and then rip back faster than pretty much any time in history. So GE could go to zero. With those things considered, Bitcoin could go to 1 million. I don't know. I don't really care. But when I look at a chart like this, I mean, this is terrible. These are lows from the early 90s. And you can see they were tested here during the financial crisis. And then if we zoom in a little and maybe look at a weekly. So there's the financial crisis lows from March of 2009. I'll throw this at the weekly close, put some sensitivity around it, and look where we're at now. I mean, that is a cluster of price memory right here. A lot of people probably bought these lows, and now they're about to go from being in a profit position for whatever it was, almost 10 years, more than 10 years, and now they're in the red, and they might be running for the exits and just trying to break even, because this is something that does not look good at all. Definitely another fade for sure.
All righty. Well, let's go into the broad markets. I'll take over from here as far as the screen share, and we'll jump into just some of the different things to keep in mind into next week. And if you can just unshare, and then we'll do this broad market recap. The static image that I decided to pull up today was the VIX. The reason why I wanted to do that was simply to show that, the VIX has essentially been melting from 84. And as much as it seems like it's down, we're still getting now to the December 2018 highs. So, that's just to put into some perspective where we were a few weeks ago. So I'll go into this chart in more detail here in a second. The main thing that I want to mention here is the SPY breakthrough on the monthly chart. And then there's really gaps above on all 3 ETFs. There's also gaps below, but all of the gaps recently have really acted as a magnet above for now. So jumping into SPY here, and what I've got here is essentially just the daily versus the weekly, looking at 1, this gap above, and then 2, we did finally break through this resistance that was really acting as a kind of this status quo where, we were testing this thing multiple times, then finally just gapped and repped on Friday. And then on the weekly side of things, you can see that we did close above this monthly SMA 20. And what I want to mention here on the weekly chart is the fact that, so this is something that, with MACD, I want to mention. You can see that I only circled the MACD crosses where the histogram broke below negative 1.5. What does that mean? That means the fast was able to really, really deviate from the slow, and the histogram is just a function of how far the fast is from the slow. So I'm only looking at moves where the fast really moved very fast down and the slow was not able to catch up. You can see this in the histogram. So every time we had a histogram move below this 1.5 area, I have circled. And so you can see here, the last 2 times that's happened, one in 2019, that was pretty much exactly where we are now. We were breaking through this SMA 20 on the monthly. Remember, this is the weekly chart, but we've got the monthly moving average, simple moving average overlaid on top. And it's just honestly fascinating to see this, the same exact spot prices in relative to that monthly SMA 20 compared to where the MACD is. We've got this huge kind of V shape here on the MACD fast. It has not crossed through the slow yet. That's why I have the word repeat question mark, because it has not happened yet. So that's the first thing to kind of look at on the broad markets on the weekly side. The second thing I want to mention here is the fact that SPY is clearly a laggard here when we look at the Qs. So if I pull up the Qs real quick, you'll see that we broke through this resistance line early last week. This is where SPY is pretty much right now. This is where the Qs are now, just getting into that huge gap, which is really this gap down that we experienced the second or third day of this crash. So the fact that we are literally almost filling the all-time high gaps, almost, I mean, I don't want to say it's an all-time high gap, but we gap down from pretty much all-time highs in this gap. So if we fill this, this is just fascinating. And we've got the same type of setup here on the Qs on the weekly with the MACD, but not necessarily with the relativity of price versus the SMA 20 from the monthly chart. Notice that we are trading nowhere near the SMA 20 from the monthly chart. It's way down here. We almost bounced off of it rather than breaking through it right now, which we were seeing on SPY. So you can see the market is in two very different spots when you compare 5 versus the Qs. So if we look at the MACD crosses, same type of thing. We're looking at those histograms breaking down, in this case, more below around 1. On SPY is 1.5, but notice I'm just looking for these big dips in the histogram to show the MACD crosses. So here we had a MACD cross on in May of 2018, continued up for the rest of the summer before crashing in October of 2018, which was honestly on a scale, this thing was nothing compared to what we just went through, at least from a time scale where we literally dropped twice as fast as we did in 2018, and we dropped more. So that's the first thing I want to mention here on the Qs. However, we are quickly starting to fill that gap. If we turn on the gap snake here, you can see that this gap is slowly starting to fill, shown by this line starting to uptick. That means that the candle is starting to move into that gap. And then we also have this MACD cross here. And I mean, if you look at the MACD cross, this has been a pretty big move to the upside the last couple times. The last one that I want to go over here is actually, we already went over the VIX. Let's do IWM. That's kind of a laggard in the market right now. And something, at least on the daily, that I think is interesting is the fact that we have this gap above, very similar to what we have on the Q. But look at how perfectly the top of this gap is in pretty much right in alignment with this 0.618 fib zone. So the fact that, this is both a gap above and the 0.618 is above, which has been tested by most of the other participants, such as SPY and the Qs, is this the next one to, catch up? We'll have to see. But on the weekly chart, you can see pretty much the same thing across the board. MACD is curling up. The gap has filled a little bit from last week, but we are starting to move back up towards that direction. And if we do anchor the volume by price from the start of this downtrend, you will see that most of that volume is still holding above, and we are seeing that that area starting to act as almost a magnet for the price. Because you got to remember, most people from November of 2017, which is when I started this downtrend on the trend line, most people are still holding in the 150s. So as people stop selling or panic selling and that supply dries up, you don't even need demand to increase. You just need demand to stay constant, and any decrease in supply is going to start driving the price up. So we don't necessarily need sellers here. We just need, we don't need buyers. We just need sellers to stop selling. And then when you've got that move on the supply and demand curve, you can see that, the price could quickly kind of act as kind of a rocket ship up to this zone above. That is my take on the markets. That is one perspective of a million. Let's hand it off to Steve again, and let's take a look at what you have on SPY and some of the other broad market ETFs.
Can you hear me?
I can.
All right. Can I show you something cool real quick? To your
Please.
point of the NASDAQ outperforming?
Yes, please.
So something we look at a lot here. Just want to show you a custom index quickly. This, let me know when you can see.
All righty.
So this is an equally weighted index of the 4 largest companies in the United States by far. This is the $1 trillion club right here. Okay, forget FANG. Netflix is tiny compared to the rest of these names. Facebook is even tiny compared to the rest of these names. It's about half the market cap of Google, which is the smallest. Microsoft, Apple, and Amazon are all, I think, in the ballpark of 1.25 to like 1.4, maybe 1.5 trillion now. So the point is, these 4 stocks are very important. They make up about probably now more like 13% of the total U.S. stock market, and they actually make up almost 50% of the NASDAQ 100. So, as you know, most stocks are not at all-time highs right now. This is one day away from being an all-time high. So these 4 stocks together continue to crank to new all-time highs. They're outperforming the rest of the market insanely, and their weightings are so big that they're driving the gains in the NASDAQ, and that's why you're seeing that outperformance. And we can visualize that here. This is the MAGA index. So that custom index that I just showed you relative to the Qs. It's hard to outperform the NASDAQ 100, but clearly these 4 stocks are doing it. So that's telling you, they're really driving all the gains. Make the NASDAQ the numerator in any ratio chart right now, and you're going to see a nosebleed uptrend. So it's very impressive to be able to chart four stocks relative to the NASDAQ and see just, straight line higher. And this is since what, 2015? This trend has been in place for a long time now. I'm going to flip back to TrendSpider now and go through some indexes, if that's cool.
Yeah.
All right. So let's look at what's going on here. Financials, super important. What's that?
The old XLF.
That's it.
Be strong.
JC wrote a blog post for you football or sports fans late 2019 when this is a monthly chart, right? So let's take a look. We had these highs from pre-financial crisis in May of 2007, and then it took us literally 10 years. It wasn't until January of 2018 that we got back. We tried again, and we tried again. And JC made a sports reference, and he said XLF might be the John Elway of markets. And what he meant by that is John Elway got to the Super Bowl really young in his career. He lost, and he went back, and he had 2 more tries towards the end of his career, and he finally won it. And we joke now, and I say, well, XLF looks more like Jim Kelly now. And Jim Kelly was a quarterback for the Bills who lost 4 straight Super Bowls. So that's what you're seeing here. Rarely do we have structural bull markets in equities without financials performing. A lot of people will make the argument that we're in a new world now, and that the big banks, the money center banks that are driving the XLF, the JP Morgan, Bank of America, Citigroup's, Morgan Stanley's, Wells Fargo's of the world, are basically just regulated utilities now. So maybe we're in a different type of market where this intermarket relationship isn't as important, but this is a long-term chart, and you can see very clearly, as long as the financials are trapped below this $30, $31 level, it's tough to be too bullish. And furthermore, if we're trapped below, this is the 2018 lows, the Christmas Eve of 2018 low that we all remember. We're running right up against it, and we're failing right now. So, we could zoom in. And again, I want to just point out what I'm talking about with using the Fibonacci for support and resistance. Look how well it's worked here. And if I, let me just make the sensitivity on this a little bit bigger. Because in my book, there's nothing wrong with that. I want to know when it gets close. It kind of respected it here, broke through it, came back, tested it. Then we ripped back up to the 61% retracement, tested it, failed, ripped through, went back to all-time highs, got met with an abundance of overhead supply. Sellers shot this thing right back down, came back down to the 618, overshot it as always, and now we're back above it, kind of in no man's land. So I'd be looking at these 2018 highs. I'll show you another one in the space. It's Jake, like you said, it's such an important point right now, guys. You don't want to be buying everything. You don't really want to be buying indexes in this market, but you don't really want to be selling everything either. There are some incredible, very powerful uptrends in place in certain areas of the market, and then there's some really powerful downtrends in other areas. And you're even seeing that not just at the sector level, but at the index level, and even within subsectors and industry groups. I mean, there's just some stocks that are doing better. For example, if you're a retailer, but you're Gap, or you're a retailer and your Walmart right now, you're doing a lot different. You're performing a lot differently. So let's look at the broker dealers and exchanges. This group is epically important to financial markets in general. So let's similarly zoom all the way back, and you're seeing a much different picture here. This is one of the largest industry groups or subsectors in XLF. Things like CME Group, SIBO, Interactive Brokers Group. So again, let's puff this horizontal resistance line. So this was former resistance at the pre-financial crisis highs. Prices finally took it out, retested it. We started going. It looked like we were going here right before the breakdown in late February. Man, this looked great. We had just sliced to new all-time highs. Oh, buying this all day. Nope, it was a failed breakdown. Failed breakout from failed moves come fast moves, which you saw in the ensuing 2 months. We completely violated those prior all-time highs from 2007. We violated the 2018 lows. Then we saw this sharp reaction move higher, but look what we're running into. Again, some serious overhead supply. This level right here, those pre-financial crisis highs, that is the level in the sand, or like I would say, the crayon on the chart for broker dealers right now. And whichever way this resolves, I think that should be a pretty good indicator for financials in general. And that's a topic that we're hearing a lot about right now. We kind of are starting to see some increased risk-seeking behavior as investors try and embrace, and I'm saying try because it was really a pretty weak counter trend move at best, but it got a lot of publicity on FinTwit and in the media the past few weeks. Small caps, cyclicals, industrials, banks, the financials in general, even like emerging market stocks are trying to catch a bid here. And we do need them to participate if this recent snapback rally is going to have some legs and actually bring us back to all-time highs. I don't think you're going to see that with, like I said, just those mega cap growth and tech names driving the markets. We're going to need to see some healthy rotation underneath the surface. We're still going to need the mega caps to participate, but it would be nice if we could see some outperformance from some areas like financials and industrials, but we're not seeing it yet. Again, Jake, you made some great points about the Qs being above the 61.8% retracement, SPY being right about there. But if you look at the small caps, sure, they've performed well. They've rallied. They had a bunch of nice gap moves last week, the week before, but they're still trapped below their 61.8% retracement. So from a more structural standpoint, there was a lot of damage done there at small caps. And in fact, small caps and transports never even confirmed the new highs in the S&P earlier this year. So those areas are still under pressure. And if we are going to see a move lower from here, you want to continue to bet on those laggards. And that's how you want to express any bearish thesis if and when we do roll over from here.
All righty. Well, from all the things we just went over, that is a pretty broad market review. We pretty much touched on everything in the book there. We didn't really touch on transportation too much, but we'll save that for another time as we have to move into the last segment of the show, which is kind of more from you guys listening, what you guys wanted to see today, and that is a few different things. Um, we've got work, which is more of what I would call kind of something that is leading the market right now, because naturally working from home, Slack is going to be something that people are maybe going to start adopting a little more. And then the last two, Disney and cake. And my ignorance showed today, because I'm looking at cake and I'm like, is this some new IPO that I've never heard of? Didn't even know that cake was Cheesecake Factory's ticker. So my apologies there for showing my ignorance. But these are the two that are laggards, right? Disney, Cheesecake Factory. They have not done anything really, because you've got a lot of that kind of dead weight holding on to those, which is theme park. Are people going to go back to these? Are people going to go back to the Cheesecake Factory in hordes, or is it going to be a very small kind of trickle in? So, our opinion doesn't matter. It's what the charts are saying. So let's jump into them. Going into work, I want to go over more or less a case study first of all on work. That is how Friday's candle closed on the raindrop versus how the overall hollow candle closed. So if we put these side by side, I've got the daily raindrop and the daily hollow candle, and you'll see here on the hollow candle, we had quite a wick, right? We had sellers come in. We had the price drop down into the close, which didn't close too much higher than what we opened at. But then if you go to the raindrop, you'll see something very different. You'll actually see within this wick, there was quite a bit of volume. And one of our biggest questions here is, well, how do you know that wasn't selling volume? Well, we know it was selling volume because for every buyer, there has to be a seller. What we're more interested in is the fact, where did those buyers step in to absorb that supply? And so if you look at this wick, you'll see that, sure, we closed much lower than what we hit intraday, but you can see within that wick, there were a lot of shares that were absorbed here. If there were not buyers at this area, we would have not seen this volume here. We would have seen this volume allocated elsewhere on the candle because there wouldn't have been buyers. But since there were buyers here absorbing all of those shares, we can see it within the raindrop, whereas you cannot see it within the wick of this hollow candle. So getting that edge in the market is all about kind of seeing things in a different perspective, which is what the raindrops do really well. So that is work. The second thing I want to mention here is if we go on the daily, you can see we clearly broke through this multi-resistance horizontal zone. There's 1, 2, 3, 4, and then finally broke out on this fifth one here. So if we go onto, the weekly, just a regular candle, and we go to this, you'll see that, the weekly is definitely breaking out of this crucial level. If we anchor the volume weighted average price from the IPO in June of 2019, you will see that huge volume base that was forming here that allowed price to kind of make the next step to the upside. And you can see here we're kind of stair stepping along these volume bases. So there's 1, there's 2. Will the next one be, obviously maybe we have to throw up a fib level, which is what Steve's been doing the entire time. If we did that, added the 61.8% retracement or extension in this case, we've got, quite a bit of room to move up, as you mentioned before. So, for those that are watching this one, this is one that's kind of finally getting out of that doldrum $30 zone, which is also psychological area. Going on to Disney, this is a fascinating one because, one, we've got this kind of laggard setup here. We finally broke through the Alpha anchored VWAP from that earnings on February 5th. And then from here, notice that last time we broke through, we quickly pulled back down. But what you can see here now is we did bounce off this Alpha Trends anchored VWAP once again, which was in confluence with this demand zone shown by the anchored volume by price from this earnings as well, which tells us most of the people that have participated since earnings in February are literally holding anywhere from around 100 to 104. So finally, the price was able to take off from there. And then, as the next level shows up, this little chunk of supply above around 116 to 118 would naturally be the next zone for the price to maybe find a little bit of friction above, just because that's where people are essentially going to start be breaking even from buying way too early on this dip. And so if we just move this over, you'll see that these people right here, that this little chunk of volume is what these people represent. Buying the dip too early, price continued down, they deal with a huge drawdown, and now as the price gets back to this area, some of them are going to be like, I am out of here. Some others may be like, I'm doubling down. So you've got that whole market participant kind of theory to see what happens there. There's a lot of different market participants, and that is generally what causes, let's say, resistance. If you have too many people taking profit and breaking even and getting out, that's going to overpower demand, and you're going to get that pullback in price. Last one that we wanted to go over was cake. And if we go to cake, simply quickly before I hand this back off to you, Steven, before we have to cut this thing, since we are running a little over, cake is one of those ones that literally looks just like Disney. We've been chilling around this area for how long now? Finally broke out of the anchored VWAP again from this February high. Remember, just because we were anchoring the VWAP and the volume profile from the February 5th high and the earnings on Disney, remember, cake hit a high in February on February 21st. So that's when the status quo, i.e. the trend reversed here, and that's where we want to start this from. So you can see most participants are holding shares around 19 to 20. And finally, we're starting to bounce off this area, which acted as almost like a step for the price to jump off of. The last one I want to go over, this was not requested, but I'm sure some will appreciate this one. This is Bitcoin. I want to point this one out simply to show you guys how well the price respected this supply zone here. So if we anchor the volume by price from this June high on the weekly chart, you'll see that we literally hit this supply zone to the T. I mean, and the cool thing about this chart was these levels were here long before this happened. We knew that there was a lot of people holding in this 97 to 10,000 area. And so naturally, as the price just dealt with a 60+% drawdown here, as those people now held through that, and the price is now up 160+% from the lows, they're like, yeah, that was fun, but I'm taking my money and getting the hell out of here. Others will not do that. But you can see here, we clearly had some type of, inefficiency where clearly there was too much supply, whether that was from profit taking, whether that was a mix of profit takers and people breaking even that wanted to get out. Regardless, we did have that pullback. However, if we did go to that daily, you will see that there is quite a big chunk of volume here that is formed since this low. So you can see we're trading right at this volume shelf. So Steve, I know you guys are quick, but let's see how quick we are with a couple charts that you want to go over with these requests. Some of the ones that people mentioned were Apple, Roku. So if you want to start on those two, and then if we have a little more time, I'll let you go a little longer. But I do want to be respectful of everyone's time on Mother's Day today too.
So totally. I love what you said, Jake, about Bitcoin really respecting those levels of interest. If you draw a Fibonacci extension on Bitcoin from, I can't seem to grab the data, but if you draw a Fibonacci extension, it is
so go
shocking.
to BTC USD and then type in Coinbase, and that will pick up the Coinbase price. And then space coin. Yep, it should pop up here. Do it yep, bingo. And then if you take it off log, you'll be able to have a little more of an easy to read chart there. Oh, or if you go to weekly, that'll do it. But that big wick messes up the log.
Yeah. Let me switch it to. There we go. All right. I think you kind of need to go back further. Let me see here. Is there a way to add the 423.6?
As a retracement or an extension.
Yeah.
Right click and go to properties, and you can add whatever you'd like, and just make sure it's
Where do I add it?
wherever you want, and level 8, and then just click turn it on.
Okay. Well, it doesn't seem to be working, so I'm going to move on. I'm messing something up here, but I'll post a chart maybe later. If you run a fib extension from one of Bitcoin's early drawdowns, mid 2010s, yeah, you'll see how price really reacted well to that over time. But real quick, let's look through some. You said Apple, Jake?
Yes.
Okay. So first of all, I know you talked about Slack. Again, love this. You got the horizontal resistance. Touch. We're breaking out now. Respecting that VWAP from the lows. What I love about this is that before we got this massive move that we're now confirming and following through on, call it what you want, a little head and shoulders here with an extra shoulder. We had a nice failed breakdown, pretty hard, and then prices just rocketed back right to that level, held the VWAP, and now it looks like we're resolving higher. I think the next stop here is going to be in the low 40s back towards its IPO price. Also, real quick, Disney, I think, is a really interesting chart from a long-term perspective. Again, hard not to err in the direction of the underlying trend. So I drew a long-term fib on Disney. I'll show you the monthly first so you could really just see it. Okay, these are highs from 2000. We broke out in about 2012, straight line higher, consolidated for a few years, broke out again, failed, retested the lows from this consolidation, which actually also coincided with the 261.8% extension level, and the highs, believe it or not, this is the 423.6% Fibonacci extension level. And as you see, that's where some supply came in as usual. We rocketed down to the 261.8 and the prior lows, and now we're pretty much in the middle of no man's land in that one. And now for Apple. Apple's just been incredibly strong again, just like all the MAGA stocks, Microsoft, Apple. And this is just nuts. The way we would look at this. So here is your, it looks like a blip on the map now, but this is actually that dreaded .com bubble drawdown that we always hear about. Oh, look at that. Prices really took off. They consolidated a bit, the 161.8. They broke out of the 261.8, came back, tested it, and then took off. If I add the, and try to add the 423.6. Oh, I did something very wrong. I'm supposed to be good at math, guys. I'm sorry about that. So 423.6 is there. We can keep going. We love this stuff. We'll do this all day. And these are the actual Fibonacci sequence numbers I'm using. Do you see how price responded so well there to all of these extensions? Really, that's not a coincidence. So then, if you want to zoom in and look at Apple more recently with a weekly chart, the way I would do that, we had a nice little base during the correction in 15-16. Let's take a look at how that extends. Again, 161.8, natural level for buyers and sellers to battle it out a little bit. We overshot the 261.8, came down, kind of retested, back up, off to the races. Now we're at the 423.6. If we take out these prior all-time highs from earlier in the year, 383, 385 should be the next stop in Apple. It is so hard to be bearish on a stock like this. What was the other one?
Roku.
Oh, Roku. A good name.
Ooh, that is a beautiful weekly. Oh my gosh.
So check this out. I would want to know.
For the you can't create the alerts yet, but you could increase the line stroke to make it a little more of a crayon type.
Yep. Totally. Yeah, so that's what I would do. One of that. Test. Here we go. Key prior highs, right? We failed here. Fall of 18. Failed here again. Spring of 19. We flagged for a little bit. Again, this was still a structural uptrend at this point. Higher highs, higher lows, higher highs, slightly lower low. But that ended up being a failed breakdown, which sparked a nice upside move. You have a little cup and handle here. Prices resolved higher. Now you have a much bigger base. What I really love about this is check this out. Buyers were having none of that. So sellers punched this thing lower in March when everything was getting destroyed, and buyers stepped in right where we would expect them to, where there's tremendous price memory at these key prior highs. And there you go. They came right in and they said, no, we still like this stock. We're defending our cost basis or whatever it may be. And that acted as a tremendous example of the polarity principle, which is former resistance turning into future potential support. And it acted as pretty good support here. You got the failed breakdown, the splashback move higher. I think this is one you want to keep watching. If this trend line breaks, I like it a lot. If we take out these former all-time highs, I like it even more.
Beautiful. Well, we have run over on time a little bit.
I apologize.
So if you don't mind unsharing your screen. Hey, you're passionate. I love it.
Thanks for having me all night. It's a pleasure.
No, we're not done yet. We're gonna do a final outro here. I just wanted to mention one thing because we did have a question about the software update. So I did want to touch on that. We are gonna have a blog post about this in the coming days, even tomorrow. I think Brad's gonna get it out. He does all of our marketing stuff and does a killer job. But before we get that official blog post, I want to touch on a couple things. The main things that we're going to go over within a minute here, we do have the new position tool. So you can define your risk reward. You simply draw it. You can then change these levels. You can change your stop. You can change what your profit target is. So if you want to really be able to use that tool of being able to define your risk, this is now the tool to use. Notice how I'm just simply moving these different pivot points on the indicator that I can simply move here. And that is how you can define your risk there. So that's the first update. Second one, let's say that I want to draw a line and I want to actually say 165 is where I want this line. Voila, there's the line. You can actually define the exact to the penny price point that you want. Remember, all you do, double click, type in your price, 165, and it is there on the chart. Last thing, we do have a lot of new colors that you can mess around with. Background, crosshairs, previous price level, all of those different things you can do. And you can also choose a number of different colors. You can even use HTML color coding. So if you do have a specific color that you want to use, go ahead and type in the code in here and it will show up. So there's essentially millions of different colors you can use, not only on the background, but also the market price line, the crosshairs, all of that different thing, the grid lines. So make sure to check that out. This is a huge improvement and allows you to personalize the charts even more. So without further ado, I am going to go into our final slide here. I know we have gone over, so thank you everyone for your time today. Website, allstarcharts.com. That's where you can find not only Steve's work, but also his colleagues' work. Tom and JC, they all post charts there and look at thousands of charts, literally. So definitely make sure to check out allstarcharts.com. And Steve, you have SS Strazza or S Strazza here. And is it Strazza or Strazza?
You got it right the first time, Strazza.
Strazza. Okay. So S Strazza, at Strazza is your Twitter handle. For All-Star Charts, if anyone wants to check out your guys' work, what is the Twitter handle for that one?
It's just All-Star Charts. And then we have All-Star Charts India's All-Star Charts IN. And a lot of the stuff that I talked about today, polarity, the way we look at support and resistance, the way we use Fibonacci, there's a ton of free resources on our website and our educational blog where you could learn about, some of the stuff that I talked about today. It just reiterates the concepts. And JC does a much better job at explaining it.
Beautiful. Well, no, we appreciate all the work you guys do. It's great to have JC on for the Volatility Masters event. And, thank you so much for coming on and spending this Sunday evening with us. And thank you, everybody, to those that watch this, whether you're still on the show or you're watching it recorded. A lot of people jump on Sunday evenings that they weren't able to watch the live, so they jump on the recording. So thank you to everyone watching this, whether this is live or recorded. And we'll see you, as always, next Sunday, 6 p.m. Eastern, with our next guest, which off the top of my head, I'm not sure who that is. So stay tuned. Make sure to follow us on Twitter at TrendSpider. Once again, happy Mother's Day to all the mothers out there, and really all the women out there that keep us sane and keep our egos in check, for all the men out there trying to be macho in the market. And we'll see you next Sunday. Everyone have a great night and a great week ahead.